Hello everyone, welcome back. Okay, so today we're going to start with one of the most important, but one of the most simple, I would say one of the most simple matrix that we are concerned with when we talk about fundamental analysis. Alright, in the last video, if you watched the last video, you know that there are three categories in terms of examining a company's fundamentals, right? You have profitability, you have a company's operational efficiency, and then last of all you have debt and leverage. So today the metric that we're going to talk about is called earnings per share. Now this metric would come under the profitability section. We are trying to examine the company's profitability. Alright, and it is actually one of the most recognized important metrics in the market, because almost everyone who does stocks would know about earnings per share. It's like investor 101 for fundamental analysis. It's very, very crucial. It's very, very important. All right. So without further ado, let's start. Now, earnings per share, denoted as EPS. All right. It basically refers to earnings per share. Right. So this is pretty simple. What you do is you take net earnings, or what is known as net profit, divided by number of outstanding shares, or number of shares outstanding. Okay, so net earnings is basically gross profits. That means everything that you earn from selling your product or service or whatever it is that you sell, minus away all operational expenses. We call it OPEX for short, OPEX, right? After you take gross profits minus away OPEX, you will get net earnings. All right. So for example, this is maybe this is company A. All right. They made a total of, let's say, they made a total of 100,000 USD. All right. And in the market now, there's a total of 100,000 outstanding shares, or shares outstanding. All right. They use these two terms interchangeably. All right. The positions are interchangeable. Shares outstanding. Right. So earnings per share would be 100,000, which is this, divided by 100,000 shares. So your shares outstanding will be 1 USD. Your earnings per share will be 1 USD. So 1 USD per share. This will be your earnings per share. Right? It's very, very simple to calculate. It's important because you want to know that for each share that you're buying as an investor, is the current value of the share at equals to the earnings, below the earnings, or above the earnings. If the value of the share, if the share price is more than the earnings per share, we call this overvalued. So the share is currently overvalued. All right. Now, if the share price is less than the earnings per share, okay, we would then call this, I think you can guess the word already, this will be undervalued. Now, looking at this very simple explanation, most people would say, then I guess I should be buying the undervalued stocks, right? Because it basically means that the share may still go up because it's undervalued. Now that will be too simple. All right. Sometimes in certain sectors, like in the sector that I'm in, software as a service, SaaS, it is normal, it is quite common to see that at the start the share price is below the earnings per share. Why? Because a business for SaaS looks at the long term. a tech company looks at the long term, especially if you're a software company. Alright, at the start you may not make a lot of money. That means your revenue, your gross rev, your net rev is not that high, but you are gaining user base. You are gaining a user base at a tremendously fast rate. And when the users come in to use that software, you have user data. That data also contributes towards the value of the company. And depending on the quality of that data, it will affect the value that it gives to the company. So it is too simple to say that, oh, just because the share price is below the earnings per share, it is overvalued, therefore I should not buy the stock. Okay, this can, I repeat, this can form the basis of one of your considerations, but it should not be the only consideration. Alright, a useful tip for you guys out there will be to compare across companies in the same industry. For example, if you want to look at the share price versus the EPS for a company like mine, like Rubik's, which is a software as a service company, because we are a mobile app, so we are software as a service. Okay, if you want to look at a company like Rubik's, it will be good to compare us to the other companies that are in the same industry, which is in the same sector, SaaS. Alright, you cannot compare a company like Rubik's, which is a SaaS company, to maybe, I don't know, F&B company. These are two different companies. They are in two completely different industries. Okay, so it is not useful to use them as a benchmark, to use the F&B company as a benchmark to measure Rubik's. Alright, it will be good to look at the share price to the EPS, okay, and then you will know exactly which company is doing better, or perhaps what is the market standard for that industry. Okay, now just to go a bit deeper, alright, okay, never mind, I'll leave that for the next video, but this is basically share price against EPS. Alright, so very simple, but very important to understand what is going on here. Okay, so thank you very much. My name is Jefford Lim from Rubik's Academy. I want to see you in the next video.